You have every form on the IRS, like every tax form is based off the 1040. The 1040 is the original form. The 1040 is the long form, and it's actually, I gave you guys a copy of it. It's not that long. It's one page front and back, but it's considered to be the long form because of all of the attachments that go along with it. It also has 77 lines. 77 lines. But there are schedules A, B, C, C, E, D, E, F, G, H, I, J, and then you get into double letters, and there are all these possible attachments for various income situations and various self-employment or business ownership or all this stuff, right? So that's why it's the long form, because it can actually be like 80 or 100 pages long when you're finished. If you had every situation. Nobody has every single situation, but regularly filling out the long form could be 10 pages easily. Then you have the 1040EZ and the 1040A. Those are the short forms. The 1040EZ is the shortest. You don't attach anything to it. It's just its own paper. That's it. That's all you submit. The 1040A has more lines on it, and you can only attach one form to it, and that's a Schedule B, which we'll go over. These are the short forms, but they have restrictions as to who can and can't use them. Now with the 1040EZ has the most restriction because it's the easy form. That's why it's called 1040EZ, is because it's easy. You cannot have any dependents. You can only be married filing jointly or single. That's it. There's no married filing separate, so it's self and spouse only, and that's filing jointly. Okay. Your income has to be less than $100,000. You cannot have interest of more than $1,500, so your bank interest has to be $1,500 or less total. You cannot have any stock dividends. And you cannot have any unusual sources of income. And by that, I mean your income can come only from like wages, salary, tips, unemployment, or scholarships and grants. And then there's something called an Alaska Permanent Fund. But unless you're an Eskimo living in Alaska, you don't qualify for that. You can't have self-employment income. You can't have royalties. You can't have commissions. You can't have anything that would come on a 1099. You can only have like stuff that would show up on a W-2 or a 1098, which comes from educational. Okay, so very restricted on the 1040 easy. And that's the first form we're going to talk about. And then afterwards, we're going to talk about the 1040A, and then Monday we'll go over the 1040. So we have Elizabeth Allison, and she is a food editor, and she got a W-2 form from her employer. We look at her income. It is less than $100,000. She also got bank interest, which is less than $1,500. And she's filing single, because we don't have any information about anything that says she's not single, so she can use the 1040 easy. Okay, so she met the requirements. So first we're going to pull out our 1040 easy. And it looks like this. So everybody needs to get one of those out. We're filling out the taxes for Elizabeth Allison. So okay. Yes. Or you can do it electronically though, but I mean, I want you guys to know how to do it on paper. Okay, so Elizabeth, Allison, okay. You have to fill out at least that much so I know which form goes with which question. They give her Social Security number is all zeros, so we'll just put that in there. That's what would go there. Your own personal Social Security number, your address would go here. Bless you. Okay. Now, if you have a spouse, if you're filing jointly, you can use the 1040EZ, so your spouse's information and their Social Security number would go here. Just bring this over a little. Okay. Now, if you worked or if you lived in a foreign country, that information goes here. Most people won't have to fill that out. And then presidential election campaign. Presidential election campaign, if you want $3 to go to the standing president to help him win re-election, you can click this here and they'll take $3 out of your tax return and give it to the president's campaign fund. And you won $3 for you or $3 for your spouse or both, if that's up to you. Okay, next, wages, salaries, and tips. Box 1 of the W-2 form. So if you look at your W-2 form, that's the number or the part I highlighted. Okay. I'm just going to keep this like this. Can you guys still read that okay? Right. So it was 83,600. So that goes right here, 83,600. Okay. So line 1 has to be filled out. Line 2 is optional really, because that's only if you actually earned bank interest. If you didn't earn interest, you don't put anything there. But she did earn bank interest of $956. So the bank interest goes here. Okay. So this is bank interest. Obviously on your real tax form you wouldn't write that in, but this is notes. So unemployment compensation. So if you were on unemployment, you pay taxes on that. So that would go there. And then add lines 1, 2, and 3, and that is your adjusted gross income. So 6, 5, 5, 4, and 8. So this is Elizabeth's adjusted gross income. Okay. If someone can claim you, so if your parents or someone claims you on their taxes as a dependent, you have to check the box. Okay. And it says here, see back for explanation. So if we looked on the back, if someone can claim you, you have to fill out this worksheet. Does anybody want me to go over that? Okay. If somebody claims you on their taxes, you have to fill out this worksheet. You have to do this, yeah. So you'd put the income and then plus 300, so that would actually be a 9 there, and then the standard deduction. Enter the larger line A or line B. Well, that's obviously line A. Then you would enter the 5950. And then the smaller, which is this one, and then that would be your standard amount. Exemption is if you're single, you're 0, or if you're married and both of you can be claimed, you enter 0, or if one of you can be claimed only, and that goes here. But we're going to proceed as if no one can claim you. So you look for your standard deductions. She is single, so it's $97.50. Okay. Then it says to subtract line 5 from line 4. So right here we added, right here we're subtracting. Just trying to double check myself. Okay, this is the taxable income. Everybody gets a standard deduction, no matter which form you fill out. Now you can choose to itemize and take an itemized deduction if your itemized deductions are more than $9,750. Like if you had more than that in expenses that were deductible, then you wouldn't want to fill out this form. You'd want to go fill out the 1040 and take the larger deduction, because the deduction comes out of your income and changes your tax. So what happens now is instead of paying tax on $84,000, she's paying tax on $74,000. So it's less tax. So the next thing you do is federal income tax withheld from W-2 or 1099. Well, she didn't have 1099. She had a W-2, and her federal income tax withheld is box 2, $15,884. So that goes right here. Okay, so this is from W-2. Earned income credit we are not going to worry about. Earned income credit is a credit that you receive if your income is below a certain level, and it is for a single person less than $20,000, I believe. I'd have to look up the current numbers, but Elizabeth is way over income levels. Okay, so she wouldn't get that. Non-taxable combat pay election. If you received combat pay, you don't have to pay tax on that. So if you're actually in combat, you don't. That goes in here. And we have total payments and credits, so we're adding all those lines together, but we didn't have anything else to add. And then tax. Tax is from the tax table. Tax table. Okay, so we have to find 74,806 on the tax table. On the 2012, that's on page 87. So 74,806 puts her taxes at 14,736. Okay, so that's her tax, 14,736. She's paid this much, and she owes this much. So this is paid, and this is the actual bill. If you paid more than your bill, then you get money back. If you paid less than your bill, then you owe money. Okay? So she paid more than her bill, so she's going to get money back. So see, on line 11A would be a refund, or on 12 would be amount you owe. So if these two numbers were flipped, we would be filling out line 12 next. But because she paid more than she owes, we're going to subtract these. So that is 15,884 minus 14736, and her refund is 1148. And that goes on the refund line 1148. That is her refund. Now, the rest of the form, if you hired like a tax professional to do this for you, which for 1040 EZ, I don't recommend, because that's the whole form, and It'd be silly to pay somebody so much money to do just that much for you. But if you hired a tax professional, like an accountant or someone that could intervene on your behalf with the IRS, you need to fill this out for them, or they fill it out if they're doing it. And then you sign and date and fill out your occupation and your phone number. You also have the option of having your refund direct deposited, and so you'd fill out your bank information here. Most of the time, if you are paying a tax professional, they are not doing a 1040 easy. They're doing a 1040, the long form. Yeah. So the next thing that may happen is if you have dependents or if you have extra expenses, you can't fill out the 1040. You're going to have to fill out either the 1040 EZ. You're either going to have to fill out a 1040A or a 1040. Now the 1040A is another short form. It does not allow itemization. Okay, itemizing is to list deductible expenses instead of taking the standard deduction. And when we do that, it's with a Schedule A form. Okay, we're not going to be doing that in this for 1040A. There's no itemization. However, it does allow dependents and other sources of income. And there are no income limits. So the difference between a 1040 and a 1040A is that the 1040A does not allow you to itemize, and then there are certain other scenarios where you would not fill out a 1040A because of all the extra pages that may have to be added to it. But again, we're not going to get into all of those scenarios. That's just too much to cover. I'm just covering the basics. Okay, so we have Kenya and Robin, and they are married with one child. Kenya is a pharmacist and Robin is a store manager. We have two W-2 forms. We have Robin's and we have Kenya's. And then we have $987 in bank deposits and $1,200 in stock dividends. And they determined that they do not have enough deductions to itemize. Okay, so now we're going to get out the 1040A form. Okay, so the 1040A form is the other short form, but it does allow you to have dependents and it does allow you to have dividends and higher bank interest and things like that. Okay, so we have Kenya. Kenya was with a YA, Omar, and Robin Omar. They have the same social security number as Elizabeth. Just kidding, everybody has their own. Okay, address. And they haven't worked overseas and they're not supporting the president. Okay, now, unlike the 1040 EZ, which we just filled out, because you can only be single or married filing jointly, you don't have to announce your status on a 1040 EZ. Because you can only be one of the two, and if there's only one name on there, you're single, and if there's two names on there, you're married filing jointly. But with the 1040A, you do have to state your status. So we have single, married filing jointly, married filing separately, in which case you have to put your spouse's name and social security number here, head of household, and qualifying widower with dependent child. Now, if your qualifying person is a child but not your dependent, you put their name there. That's very rare. Usually, if you're head of household, you have a dependent. That's an actual dependent. Okay, so they are married filing jointly. So we have to check that box. Okay. Then we have to claim exemptions. Now you get one exemption per person in your household that you're claiming on your taxes. So there's one for yourself, one for your spouse, and then they have a child and they didn't tell us the name, so the child's name is Kid Omar. You have to fill out this information for every child. The dependent's relationship to you, we'll just pretend kid is his son. So you'd say son, daughter, stepchild, niece, something like that. Or if it's your parent that you're caring for, you'd put parent here. You have to put the relationship. If you're somebody's legal guardian, you'd put that in there. You know, just the relationship. And if they're under 17, you check mark. Now, 6A and B, that's these two. So there's two people in 6A and B. And then 6C, we have children that lived with you, children that did not live with you due to divorce or separation, and there's separate instructions for that. And then dependents on 6C that are not entered above. This is just children. These two lines are only kids. So this is kids only. In this case, there's one. But if it was a parent that you cared for, they wouldn't go on the kids line. They'd go on this line down here. Or if, you know, you're maybe not your parent, but maybe you care for your sibling or something like that, but they're not a child. So these two are children. This is non-children dependents. Then you add up all the lines. And this is the total number of exemptions that they get to claim. Exemptions are going to lower their taxable income. So it lowers taxes. So exemptions are a good thing, which is why people lie about them and list like their horse or something here and claim them as a dependent even though that's not legal. And that can get you in a lot of trouble. Huh? I don't know. I don't know how, but they get caught. I don't know how they do it or what they're doing, but I know I've heard of it happening. Or claiming something, yeah, somebody else's kid and things like that. But you can get in a lot of trouble for doing things like that. And we'll talk about that when we talk about the 1040, but there's a difference between tax avoidance and tax evasion. Tax avoidance is legal. This is tax avoidance. Tax evasion is illegal. So we'll talk more about that later. But right now, they get 3 exemptions. And then we have to do their wages, salaries, and tips. This is the total wages. So we have to add together both of them. So we'll go back over here. And he had $65,120.97. And she has $52,126.76. Oops. I forgot to hit the plus. So all together they have $117,247.73. So that's what goes here. Okay, so that's their total wages for both Kenya and Robin. Now, what we did not see on the 1040 EZ is this next line where it says attach Schedule B if necessary or if required. See how it says just here, it just says taxable income, and then if it's over $1,500 you can't use. The Schedule B is for multiple sources or for over $1,500. Okay. Now, when we look at the example problem, they say they received $987 on interest in bank deposits and $1,200 in stock dividends. $987 is below the $1,500, and they're not listing multiple banks, so they don't have to fill out a Schedule B. It's not required for this particular situation, And so we're not going to fill out one today for them. But if we did fill out one, it looks like this. Okay. And part 1 is banks, part 2 is stocks. This is a very, very simple form. See these lines? This is where you list the banks. Over here you list the amount of interest you got for each bank. And down here you add it up. So it's a very simple form to fill out. But like I said, because they're below $1,500 and they only have a single source, we don't have to fill out the form. And their taxable interest was $987. So we'll put $987 right here. Okay. Tax exempt interest did not get added into here. Okay, tax exempt interest isn't usually from a retirement account. There are some others that you might have. So the way a retirement account works that's tax exempt is that any interest you put in there or any money that you put in there today, any interest that's earned, any money that you put in is not taxed now. It's taxed later when you take it out. And so you still get a statement of I earned this income or this interest, but you don't include it in this amount, but you list it down there. Because it does get reported to the IRS, and so you need to account for it. If you have a retirement account, that interest goes right there. Okay, ordinary dividends. These are stock dividends, and we did not do the stock chapter, but stock dividends are paid sometimes. What happens with dividends is if you own stock, you own part of the company, and so the dividends is leftover profit that gets split amongst stockholders. Not every stock earns dividends, and even stocks that do earn dividends don't earn dividends all the time. But if you earn dividends, they mail you a check, and they send you a statement at the end of the year, and this is what you fill out for ordinary dividends. Again, though, you only have to fill out the Schedule B if you have multiple sources for the Schedule B. Okay. When we look at our example problem, it just says they have $1,200 in stock dividends. It doesn't list a bunch of different companies. If you have one company, you don't have to fill out the Schedule B. So we're just going to put the $1,200 right there. Okay, so they got the stock dividends. And then you have qualified dividends, and we're not going to get really into those, but if you're earning those, you'll know it. And then there's instructions on that, which this paper, unlike the 1040EZ, which had instructions on the back, this paper has like a separate PDF that you can download online of instructions. So you'd want to look at that. Okay, capital gain distributions. Capital gain means you own a business, or you're getting capital gain distributions from like somebody you own stock with. So you'd know about that to fill that out. IRA or IRA distributions, this is when you're taking money out, you are currently retired. When you're retired, you start paying taxes on this, and there's a how much you get out versus how much is taxable. You won't have to worry about this anytime soon, and they'll probably have changed this form by then. Pensions and annuities, again, retired. You won't have to fill this out for a long time. Unemployment or Alaska permanent funds. So if you collected unemployment, that money goes here. Social Security benefits, you are either retired or disabled. At which point you would have a form, like a statement that would tell you the total of your benefits and the taxable amounts. Those would come from those different various banks, businesses, the government. Okay, then we add all that up, and that's our total income. Just change this back to standard. So I have 117,247, 73, 987, and 1,200. So that's their adjusted total income. And you only add up this, you don't add up anything that's here. Any questions so far? Okay. Now, we get into some adjusting. Okay, educator expenses. If you're a teacher and you spend money on your class, you can take a maximum of $200. You have to have receipts for it, obviously. So if you bought markers or pens or paper or something, posters, things for your classroom, you can deduct up to $200 of it, and that goes right in there. Okay. IRA deduction, IRA deduction. You want to see instructions. This is money put into a retirement account. Student loan interest deductions. This is student loan interest paid. So not accumulated, but actually paid. So while you're in school, you accumulate student loan interest sometimes. If you have an unsubsidized loan, you can't put that on there. But once you start paying, then they send you a statement every year about how much of the payments you've made was interest, and you can deduct that. There's instructions for how much. Then you have tuition and fees. This is out of pocket. Okay, so if you have a scholarship or a grant or a student loan, you cannot claim anything here. You can only claim if you're paying tuition and fees, like out of pocket. Like I paid for this class myself. I wrote the check out of my own money and paid for this. Yes, you could claim that $30 every semester. So you guys could claim $90 a year if you go all 3 terms. And every little bit adds up. So, you know, it takes $90 that you're not going to be taxed. And in 2012, that would have been $10. So it saves you $10 in taxes. You know, I mean, it's $10. $10 is $10, right? Okay. So you'd add up all of these. These would be your total adjustments. Just going to double check, but I don't think in our example problem we had any of those. Yeah, none of those. Okay, so we have no standard, none of these adjustments. So what you would do is if you had an adjustment here, you'd subtract, take this amount out of that amount, and it would give you your adjusted gross income. Any questions on the front page? This number, 1943473, and we rewrite it. Wait. 119. 434. So all you do is you take it from the back, or from the front to the back. You just copy it over, and that way you don't have to flip back and forth. Okay, anybody born before January 1948? No? Okay. Anybody blind? Okay, then you don't worry about those. Okay, if you're married filing separately and your spouse itemizes, you just click that box. You don't do anything else with it, you just click the box. We're not going to worry about that. Okay, standard deductions. Standard deductions are over here. Okay, if you're single or married filing separately, you have married filing jointly, and you have head of household. Oh, the highlighter's ruining that. Okay. If you look at your your standard deduction, and then you look at the expenses that you could itemize, you want to compare these. Okay? Personally, for me, I'm filing head of household. Back in 2012, that was $8,700 was the standard deduction. So I look at what my total of itemization is, and if my itemization total is less than $8,700, I want to take the $8,700. You want to take whichever number's bigger because you're subtracting this from your pay. So it reduces your taxes. So if I'm less than $8,700, I'm going to take the standard deduction. But if my itemization total is more than $8,700, I'm going to itemize, and I'm going to switch to a different form. So even before you start filling out the forms, you'll want to look at that and see, is it going to be worth it for me to itemize or to take the standard deduction? And right now, we're not itemizing, so we're not going to talk about what things you can itemize. We're going to talk about those on Monday. But when you look at the list, most of them you'll say, yeah, I don't even have that or that or that or that, you know, and then you'll know right away. But they decided they did not have enough to itemize, so they're taking the standard deduction, and they're married filing jointly, so they get to take $11,900. So that goes right here. Okay, and then we subtract. So we take their total income, and we subtract $11,900. Okay. Then we have exemptions. Remember I said we get one of these per every person? We go back to the front, and we look in this little box right here. There's 3 exemptions. Multiply 3,800 by the number on that box. So it's 3 times 3,800. So it's 11,400. Okay, and then we subtract again. Is that 554? No, 534. We've brought our income down to 96,000. And that was not doing anything. They didn't have any of these adjustments. They didn't take itemization. This is just the standard that you get. You get a standard deduction, and you get $3,800 per person. I think it's actually a different number this year, but in 2012 it was $3,800 per person. Now, tax. This is tax table. Tax is always going to be from the tax table, and you're going to use your taxable income to find your tax. So we go to the tax table and we look for 96,134, which is on the very last page. Right here, they're married filing jointly, so their tax is $16,091. At this point, if they were still up over 100,000, let's say they were still in the 107,000, we would use these charts. You'd use this chart right here. So you would put the 107,000 right there, multiply it by 25%, and then subtract 7,940 from it to get their tax. But if they're under 100,000, we can just use the tax table. Okay. Then we have some credits. Sorry. Deductions and exemptions come out of your pay. So they reduce your pay. So they reduce how much your tax bill is by reducing your pay. Credits come out of your tax bill. So they get subtracted directly from the amount of tax you owe. So deductions get subtracted from your pay. credits get subtracted from your tax bill. But both of them lower your taxes. Does that make sense? Okay. Child and dependent care expenses, there's this form 2441. So if you pay for daycare, or if your parents are in a nursing home and you pay for it, you can fill out this form and you get a tax credit for it. It's not the full amount that you're paying, but there's a formula on that form. Credit for the elderly or disabled, there's a Schedule R. Education credits, there's another form here. If you're going to school, there's like the lifetime learning, there's hope, there's a bunch of different education credits. You fill out the form to see if you qualify for. You have to be in college for these. Retirement savings contribution credit, there's this form 8880 that you can fill out and see if you get a tax credit for retiring a certain amount of money into your retirement account. Child tax credit, most people that have kids will qualify for some kind of child tax credit. So if you have kids and you're filling out your taxes, I recommend 8812. And then you add these up, okay? Once you add these up, you put that right there and it gets subtracted from your tax bill. It lowers the amount of taxes you owe. But we're not doing those. Okay. Now we get to what tax they actually paid. So again, this is the bill here, and this is the paid. So, back to our example problem, and for our taxes, we have $8,765.99, and we have $6,198.65. Oh, darn, I did it again. Okay, so they paid $14,964.64. Which will go on this form. Okay. If when you fill out your prior year tax reform and you get a refund, you can apply it to the next year if you want to, so you overpay for the following year. And actually you could do that several years in a row, I think, and end up accumulating money that way. Use it like a savings account. You don't get any interest though, so it's not a really good savings account. But if you paid from your 2011 return to your 2012 taxes, you'd put that money here, which we didn't do. Earned income credit, that's a Schedule EIC. For a family of 3, the income limit is right around $40,000. So they made way too much money to qualify for this. Again, non-taxable combat pay election. If you got non-taxable combat pay, additional child tax credit, Schedule 8812, you would have already filled that out so you'd know if you were getting that or not. American Opportunity Credit, which is an 8863, that's another education credit that you would know once you filled this out if you're in high school or college. And then you add these together and that's your total payments. They paid less than their bill. Because they paid less than their bill, they're actually going to owe money. So I'm going to take this 16091 and subtract 1496464, and this is how much they owe. And that goes right here on this bottom line. And they have to pay that now when they file their taxes. Yeah, I don't think it is either, but I'm just saying they have to pay that.